Hello and welcome back, everybody. So I hope you enjoyed the first two lessons of this course. They essentially started off with explaining what the blockchain is, consensus mechanisms, hitting on why we need them to, in a decentralized way, understand immutability through decentralized consensus. And now we are looking at different types of consensus mechanisms. So essentially proof of work and proof of stake. So we've so far been talking about Bitcoin, which is proof of work. And the type of work you're doing is mining. And what essentially that means is you're paying in electricity for the right to build a block to get Bitcoin from it. And so you are essentially securing the network with the amount of cost it takes to use use electricity to mine blocks to find Bitcoin. And that's the level of security of the network. And that's what you would have to overcome in order to do an attack on the network. And we'll talk a little bit about attacks on the network in this session. So just to cover briefly what we've talked about, blockchain basics would be, having looked at Bitcoin blockchain and peer-to-peer transactions, being able to use it to send value to each other. And then we have hit a little bit last time on Ethereum and how it's used for smart contracts. And we'll look a lot more at that in the next couple of lessons. And then there are other types of blockchain consensus networks that are used maybe in a business, like SparkNet or Hyperledger. And that starts to become where you choose blockchain consensus mechanisms based on what you're using the blockchain for. And to kind of understand that, we looked at Byzantine generals problem and essentially the idea that blockchain's, I guess, like killer revolution was being able to solve the Byzantine generals problem, which has been so far unsolved. And now we're looking at the different ways it's done it. The first one being the proof of work consensus with Bitcoin, and now proof of stake, which is kind of today's focus. So what is proof of stake? Again, we'll have a video after this, which will kind of go into the specifics of it. But essentially, when you think about Bitcoin miners, as I was saying, are using electricity to get these Bitcoins. And if it costs too much to get the Bitcoins, they'll turn off their miners. And that then leads to the average security of Bitcoin. And so far, the hash rate that is supporting the Bitcoin network has always gone up. But later in the lesson, and actually the discussion for this lesson, which I'll go into later, is about what happens if that security is brought into question and the security starts to go down. What would be the effect for Bitcoin in that circumstance? So we have a couple of different types of consensus mechanisms we're going to look at, and today's one specifically is proof of stake. But there are also other types of consensus, like practical Byzantine fault tolerance, proof of authority, other ones that we'll look into in the future that you can look into as well. But today's main one is on proof of stake. So I'm going to let this video kind of take it away because it kind of goes quite well into the difference between proof of work and proof of stake and how that evolution has occurred over time. So enjoy.
Welcome to Whiteboard Crypto, the #1 YouTube channel for crypto education, and here we explain the topics of the cryptocurrency world using analogies, stories, and examples so that people like you can easily understand them. In this video, we are going to explain what proof of stake is, how it differs from proof of work, and some other interesting ideas that we found other YouTube videos have not covered. Let's dig in. First off, to understand proof of stake, you really need to understand proof of work. As we have said many times on this channel, you guys seem to learn best through analogies, so we're going to use one. Imagine that there's a foot race, and a bunch of people line up to the starting line. There are people that are 6 foot tall, there's people that are 4 feet tall, there's guys, there's girls, some people have injuries, others have just drank a Red Bull, some are old, some are young, and we have a little bit of everyone at this race line. Boom goes the gun, and everyone starts running. Whoever wins this race gets a big reward. Here's something important though, there's no second or third place trophies. There's no participation trophies either. This is kind of how proof of work actually works, except instead of one race, there are continuously races back to back. You don't have to be a genius to know whoever wins one race will likely win a bunch of others, simply because they may be in the best shape with the best conditioning. However, with proof of work, there is some luck involved. So even the small players, the dude who is on crutches at 75 years old, does have a chance to win. Even if it's a long ways away, he's still got a chance. For example, maybe everyone ahead of him gets struck by lightning, and they have to go to the hospital, and so that 75-year-old on crutches wins. Nevertheless, when it comes to proof of work, instead of runners, miners use computers to do the work. It's actually called proof of work because they are working really hard to prove that some computation is true. Now, we actually have a proof of work video that explains exactly what these computations are if you're interested. In short, the better computers you have and the more computers you have, the more likely you are to win that block. Now, let's move on to proof of stake, because that's what this video is about. We still have all of those runners lining up to the race. However, this time they don't all run. Instead, we pick one runner to run, and when they reach the finish line, they get rewarded. There's a catch though. To be at the starting line to even get picked, you have to put up what is called a stake. A stake is a sum of money that you put up so that if you do something bad, like for example if you don't finish the race, your stake can be taken away as a punishment. Why? Well, this is so that you don't do bad things. Now, at this point in the video, we already know you have some questions, so let's dive in. First of all, what happens if these people do not finish the race? Because there's the big important question of what if we pick someone to run, but they never finish the race? Meaning, what if we select them to validate a block, but they give up? Well, since they signed up to be a validator and they did not validate, either because maybe they didn't want to, or the node was set up incorrectly, or an internet connection issue, or maybe because their computer simply was turned off, we do what is called slashing them. Now, slashing is a term used when you take away some of their stake. You know, some of those coins that they initially locked up. If you don't want to lose your coins, you better be a reliable node. And this way we can say that the people that are validating blocks are reliable. Another question you might have is, how do they get picked? Every proof of stake model seems to have a few different factors that they combine to pick each validator to validate the block. Some models take into consideration how many total coins they have staked. In theory, the more that you stake, the more trustable you should be. Other models take into consideration how long you have been staking. For example, people who have staked for a long time ought to be reliable and trustable. Furthermore, some models even take randomness into consideration so that there's a fair way to get picked. Most models actually combine all of these, and if you want to know the specifics of a specific coin, you'll have to read the specific blockchain's white paper. Another question that is worth asking is how short or how long is the race? Well, in proof of work, we make the race longer the more people that run. In other words, we make the work harder and harder as more people try to race. This way, blocks aren't solved too quickly, but they also aren't solved too slowly. However, in the terms of proof of stake, the race, or the validation computation, is shortened so much so that a single computer can actually solve it fairly quickly. In some cases, even a modern smartphone could solve the problem. Take this in comparison to millions of expensive Bitcoin miners out there mining for 10 minutes to solve a single block. The last important question is, what if someone cheats? If someone cheats, or if they perform any type of fraud, like maybe they give themselves free coins, or maybe they make a fake transaction, they are then fact-checked, and if the fact check is proven wrong, then their stake is removed. Now, this is actually the purpose of staking in the first place, to make sure that people aren't joining and just sending themselves a bunch of free crypto. Instead, we make it so that anyone can fact check a validator's block, and if they find an issue, there's a way to report it, and then that validator will lose some, if not all, of their staked coins. So by now you probably have a pretty good understanding of how proof of stake works and maybe why it's better than proof of work. However, let's get into the transition. Proof of work is a very successful consensus mechanism simply because, in theory, anyone can join the network, even if they have a really small or less powerful computer. However, as the network grows, the cost to join becomes even more, because those small, less powerful computers can still join the network, but they're playing a luck game. They could still win, but it's unlikely. The idea is, if you have an old laptop laying around, you might as well mine, right? That's the idea. Well, it is actually a good idea to move from proof of work to proof of stake when a network grows very large. You don't want to do it too early because then the coin holders who stake their coins might be able to join together and actually perform what is called a 51% attack. And you don't want to do it too late because there may be lots of people wasting massive amounts of electricity and the use of those computers. That is actually one of the reasons Ethereum is moving from proof of work to proof of stake, because they are wasting a ton of electricity. Ethereum is actually at the sweet spot right now. There are enough people interested that there's no sizable whales out there, which means the risk of 51% attack is much lower. If Ethereum actually started off as a proof of stake mechanism, it may have not become so successful. In fact, this channel was started because I got interested in Ethereum mining. I could use my computers to earn useful money. This led me down the rabbit hole of how to learn how it all worked, and then my friend Nico and I started sharing it with you. So a lot of coins don't necessarily start out at proof of stake, they actually start out as proof of work, and then when they get large enough, they switch to proof of stake. So this begs the question, will Bitcoin change to proof of stake? In short, no. The code of Bitcoin is not coded to switch its consensus mechanism from proof of work to proof of stake, and the creator, Satoshi Nakamoto, is actually unknown and remains unknown, so the code will stay unchanged. The only way that Bitcoin could switch to proof of stake is through what is called a fork. And if you don't know what a fork is, definitely subscribe because our video on forks is coming out pretty soon. So what would it take to change Bitcoin to proof of stake? In fact, Bitcoin is only changed if there is a fork. Now basically a fork is a change in code, and for that code to be accepted to be changed, we would need 51% of everyone in the Bitcoin network to agree to the change for it to actually change. If 51% of the entire network agreed, the code that is running Bitcoin could change to proof of stake, but that is highly unlikely because a large majority of the Bitcoin community wants to keep the code as original and pure as possible. In a sense, they want to keep the code the same as it was written as much as possible other than fixing major bugs. Now, let's talk about economics, because there are economics involved with proof of work and proof of stake. In proof of work, you are basically investing in computer hardware and electricity. Now, this incentivizes people to find a way to get cheaper electricity that we hope is cleaner, but in reality, there's no reason that miners should use clean energy unless it's more affordable. In terms of computer hardware, we saw what profitable Ethereum mining actually did to graphic card prices. In fact, prices of GPUs that are a few years old are higher than the original MSRP that they sold at simply because miners could earn such a high return. This incentivizes the growth of faster computing and the increase of production for equipment manufacturers. In proof of stake, however, what is incentivized? Well, to become a miner, you simply have to buy the coin. You do have to have some specific hardware, but that's usually not that expensive to buy. So instead of investing in the hardware and electricity, you are actually investing in the native coin itself, which, by supply and demand, would put a lot more demand on the coin since it can actually produce an income. This means switching from proof of work should increase the price of a coin by inherently increasing the value of what that coin can do. So lastly, we want to talk about something called delegated proof of stake, which is like proof of stake's cousin. Instead of setting up a validator node yourself, hoping that your computer stays online all the time and that your internet connection is reliable, you can actually stake your coins and then use your voting power to delegate to someone else who has that validator node set up correctly. This way, you can vote without needing special equipment or knowledge. Delegated proof of stake has its benefits and its drawbacks, and if we get enough comments on this video about it, maybe we'll create a specific video on it.
Okay, great. So now we have an understanding of the difference between proof of work and proof of stake. We can now kind of look at the intersection between blockchain and cybersecurity and why these two different consensus mechanisms would change the cybersecurity features of each of the chains. So importantly, again, going back to the purpose of why you would have a chain, you want to make sure things are immutable so that they don't change over time or you can't go back in time and change the records. You need to have that resistance from the tampering of the ability to go back and do that change. And then it has to be decentralized control, or it has to be, different levels of decentralized control. So whether it's a Bitcoin network, which is across all people and anyone can mine, to Ethereum, which is somewhat similar, to a private blockchain, which might be just, several nodes in your different office buildings or something like that. But nonetheless, there needs to be kind of a way to distribute the ledger, because that's part of the security mechanism that makes sure that one bad actor can't make all the decisions. And so a hacker would have to then hack multiple locations all at once or overcome multiple nodes in order to change the truth. And that's the security mechanism that makes it, rather than just one person being able to hack, oh, I got the key and now I can start messing with your systems. You have that extra layer, which is the whole point. And so when we think about the cybersecurity implications, we need to start going into how and why, because nothing is hack proof, but so how could the Bitcoin or the Ethereum network be hacked? And so we talked here a little bit about the 51% attack. And I'm going to let the video explain it a little first. But essentially what we're looking at is, in any network, the decentralization is key, right? So you have multiple people with keys to the same lock, and a certain number need to turn the key at the same time for the lock to open. Now, if you can corrupt, let's say it's 7 people, you can corrupt 4 of them. You've basically overcome the decentralization of the network. And it's no longer decentralized, it's now centralized around your power, and you can start to change it and do all sorts of things. So how does one become the owner or the centralized power of a network? That's what a 51% attack is. And it differs a little bit for proof of stake networks, which we'll go into, where I think it's 66% of the network must be in control. But nonetheless, the majority of the network must be in control for bad actors to start making fundamental changes. Otherwise, they're punished for their actions, either in Bitcoin mining, because they wasted all that electricity and their attack didn't work. So it would be like millions of dollars of cost to try and attack for only 10 minutes. And in Ethereum, it's the staked amount that you have that could be slashed if you are found to be a bad actor. So I'll let the video take it in a little further than that, but that's essentially what we're talking about here.
One of the reasons blockchains like Bitcoin and Ethereum are so popular is their decentralized nature. But what happens if it's ever compromised? What is a 51% attack, and how does it work? Also referred to as a majority attack, a 51% attack is when an attacker or group of attackers gains control of more than half of the network's mining power or hash rate. As a blockchain relies on consensus between network nodes, a party which controls the majority of a network's hash rate will have the ability to modify and alter transactions on the chain whilst they are in control, including performing double spends, where an attacker could essentially use the same coins twice. The good news is that a 51% attack cannot alter the number of coins or tokens generated, create new coins, or transact with coins or tokens belonging to others. It's pretty difficult to orchestrate a 51% attack, especially on larger, more established blockchains like Bitcoin. You'll need a massive amount of computing power for proof-of-work networks or a huge stake for proof-of-stake networks, and doing so is prohibitively expensive. However, smaller networks have fallen victim to 51% attacks in the past, including Bitcoin Gold in 2018, Ethereum Classic in 2019, and multiple attacks on Vertcoin in 2018. Aside from lost funds through theft, 51% attacks are harmful to a network's reputation and can cause investors to sell off their holdings and the blockchain to lose market value. So, how can it be prevented? 51% attacks involve forced reorganization of the blockchain and is not the result of any inherent security flaw. Thus, the attack can theoretically be launched against any blockchain. The best way to prevent and deter a 51% attack is to grow the blockchain network. Essentially, the bigger the network, the more nodes participating in it, the more hash power, and the higher the cost of taking control of it. In proof-of-stake networks, it's even riskier to mount a 51% attack, since the other honest validators can vote to ignore the attacker's chain and simply slash all of the staked ETH. This itself is already a built-in defense against 51% attacks. Have any more thoughts on how to stay safe in crypto? Let us know in the comments below.
Okay, great. So now we know essentially a little bit of the difference between proof of work and proof of stake. And now we also know kind of the challenge essentially that we're trying to overcome. It's important to kind of understand why you would use these two different networks. And in addition, why you can't just come up with a new network and launch it and expect it to be secure enough because of its lack of usage, for example. So we'll go into that. So the first element is the energy efficiency. Obviously, this is the elephant in the room. Bitcoin uses enormous amounts of electricity. The videos that you watched previously are actually older, like 4 or 5 years old, and so the amount of electricity Bitcoin is using is pretty extreme when you compare it to the amount of electricity that's produced in the world. And there are different ways to think about it. Some people would say that yes, some of the mining that happens is gas flaring capture or usage from underused hydro plants. And in Texas recently, it was used as load balancing, where because of the cold, they needed more electricity to the grid, and because of that, they could turn off Bitcoin miners in order to provide that electricity. So there are a lot of positive elements you can talk about with how Bitcoin mining is trying to make a positive difference in this aspect. But obviously, the very big truth of the matter is irrespective. It's using a very large amount of electricity that could be used for other things, and so the opportunity cost is massive. And if you think about fossil fuels, Bitcoin miners will find the cheapest use of electricity, and so if that is fossil fuels, in certain circumstances, it will be used. And so the idea that Bitcoin is a positive for the environment is pretty hard to sell. What is the argument that I would argue people are the most spoken about argument and the most locked in argument is essentially, what would you pay for a trust machine? And the amount of energy that it's being produced is, or being used, sorry, is fueling a certain amount of value that is currently being used, or a certain amount of energy is also being used in other systems to do the same thing, like dollar and other places, like other currencies. I don't know the energy usage of other currencies, but they say that it's equivalent or something like that in terms of printing it all and sending it around and all the different electricity that's used in different banking systems. So the argument that Bitcoin stalwarts would use is that you're not paying for nothing, because these coins and this network has reached maturity where it is actually processing value, and so is inherently a utility, much like electricity in a way, but a utility of, in some cases in countries, like freedom from oppression. Now, all that said, the other side of the equation might say that Bitcoin is the first iteration of consensus mechanisms, and now that there have been improvement to mechanisms, continuing to use Bitcoin as the primary network is like choosing to use, I don't know, Windows 98 instead of the most recent edition, or something like this. And so if it's technology and you can find better and more useful ways, especially ones that don't use as much electricity and have other benefits, why would you not move that way? And the argument between these two would be, if you move fast, you don't know the consequences. So you have to be constitutional, if you will, with your code. Very hard to change, and you don't change much of the code except to repair it. And that would be proof of work Bitcoin. Or in Ethereum's case, large, massive upgrade. So they changed from proof of work to proof of stake recently, which is a huge upgrade to make. It's kind of a leap into the unknown. It's like moving an entire building from one location to another, essentially, is the level of kind of difficulty you would have to think about trying to do to change it. But they did, and now they operate as proof of stake. Bitcoin proponents would say, we haven't seen the network operate long enough to be able to trust it at that state. But one of the questions we'll ask later in the discussion is, if Ethereum does operate without fault or hack or obvious problems for a certain amount of time, what will be the implications for the Bitcoin network if security becomes equal or higher on Ethereum? if you believe proof of stake is equal to proof of work. So we'll talk about that towards the end. So 51% attacks, as we kind of just saw, is one of the challenges. And so what a network must do is reach a certain size so that a large rich actor can't come in and buy up the supply and stake to create central authority or outmine somebody else. And the two kind of networks that have done that so far are Bitcoin and Ethereum, because enough electricity is being used to make it unfeasible to do an attack like this. And in Ethereum, same for the amount of value staked is high enough. Okay, and so when we think about the real world application of this, what we're really looking at is how will, like right now we're playing with, securing internet money, and it's Bitcoin and it's etc. But what if we're securing Apple stock, or what if we're securing all the houses in Fannie Mae or Freddie Mac's inventory, or something like that, where the value of the underlying assets are really, really large? In that case, we really have to understand what network we're choosing to secure them through, because just because it's distributed doesn't mean, as we saw, it can't be attacked. And so what we mean by that is, let's say, for example, you were to go and tokenize an entire company and put it on Ethereum. That would be fine, because the overall, well, depending on the size of the company, to be honest, but the Ethereum blockchain as a whole secures more value, billions of dollars, like up to, I think, $250 billion at the moment, than the value of that company. Let's say it was 500 million or something like that. That means that in order to mess with that, a certain amount of value would have to be spent to try and perform that attack. And so it would actually be still economically infeasible to perform an attack on an asset that is much lower value than the total assets that are being secured by the network, because the network just wouldn't accept it. That's the way it's built. However, if you were to try and do something like secure that on a much smaller network, one that you just spun up, it then becomes a question of, is the price of attacking your network lower than the value that can be stolen from the network? And that's when blockchains get into trouble, because there are lots and lots of smaller blockchains that just get spun up, and they have to grow and scale to scale their security to be worth using by any large entities. And so when it comes to real world applications, generally what this means is they will always, for now, be launched on Ethereum or backed by the Ethereum network. And this is if they're large, worldwide entities, banks and things like this. And that's simply because of the longevity of the chain and the fact that it secures enough value to have enough security to actually do that. And that will always be the problem for all chains, is that they cannot run and secure value unless they either sacrifice security for centralization, and this is somewhat what a chain like what Solana would do. Don't get me wrong, it is still decentralized, but it is less so. Or they are taking a risk because it makes it worth it to attack the chain. I can go into a little bit of what this looks like for entities interacting with these chains, but I won't for now, because that's something for another time, because there are things that you can do to protect yourself against a chain that may be hackable. And that's like, for example, putting in wait times. So you, instead of just transacting in the next block, hoping that the previous one wasn't hacked, you wait, in some cases, 16, sometimes 100 blocks to make sure that the attack cost would have been too much for someone to have taken that long without having revealed themselves. But we'll talk about that in a future lesson. So one of the things, as we were talking about with securing things through a network like this, is why would you want to do it? And the reason is because it settles way faster. The idea that you could carbon credits ensure trade your carbon credits on an open market at any time of the day, anywhere in the world. And they settle immediately or within 10 minutes rather than it taking a week. Just speeds up the business cycle or the velocity of money, sorry, and it helps improve your business. And so for that, you see things, and you can search them yourself, but Societe Generale, for example, has launched green bonds on Ethereum. Other banks have started to use Ethereum as a way to send and transfer money. And that's pretty interesting to think about because they aren't using the Bitcoin network, they are using the Ethereum network. And yeah, that's something to kind of consider for the Bitcoin network to think about. And so one of the things I wanted to include and show you is just a recent video from Larry Fink from BlackRock, and he is basically saying this, that the future of securities will be tokenization for the reasons I mentioned. And so essentially what the situation we're in right now is one in which chains are competing to grow in size, to grow in security, so that they can prove that they're worthy of having value transacted on them. And the mechanism through which the consensus is achieved has been upgraded from proof of work to proof of stake. Upgraded is an interesting choice of words, but nonetheless, I'm going to stick with it. Yeah, that's kind of a way to think about it.
I actually believe this technology is going to be very important. Look at it. We have been part of the huge revolution in investing through ETFs. We believe that ETFs will be changing the whole way we invest. Many people still use it as a means, people are investing it for indexing. No, the majority of people who are putting money in in ETFs are active investors that are buying exposure. The entire bond market is being transformed as we talk right now. I believe the next generation for markets, the next generation for securities will be tokenization of securities. And if we could have that distributed ledger that we know every beneficial owner, every beneficial seller, we all have our code of who's buying, who's selling, instantaneous settlement. And think about it, it changes the whole ecosystem.
Okay, and so that leads into the discussion of this week. Essentially, what are the implications for the Bitcoin network? So this is the network that is, as we've just discovered and looked at, is very conservative with its changes. Its premise is it's based on security, and the amount of electricity used secures this network. And it's a truth machine. And because a huge amount of electricity secures it, it is able to be used in that method. And that's great. It's currently winning. It's the first mover. However, looking forward, if the security of Ethereum, and the way we learned about it in the video, is the security of Ethereum is measured by the aggregate price of all the tokens in the system. And so currently, I think it's like 250 billion, maybe. And so the security of Ethereum is $250 billion. What happens if over time the security of Ethereum increases such that the price aggregate is above Bitcoin? And it could be perceived by people that not only is Ethereum easier to build on and less energy efficient, but it now also has this more security or higher level of security than Bitcoin. What are the implications for the Bitcoin network in that case? And in addition, what can Bitcoin do about it? And maybe would they want to do anything about it based on this idea that perhaps that proof of work or proof of stake can exist together, and they each serve different functions. So this is the point of discussion for this week, and I've posted it in the chat. In the discussion log. Okay, so inclusion and recap. Blockchain fundamentals underwrite what all blockchains are about. Obviously, immutability, decentralization, as we've talked about. But there are different ways to reach consensus, proof of stake versus proof of work. And these have different implications for cybersecurity and are kind of the evolving face of of cryptocurrency as we see it today, especially with last year's Ethereum merge, where they moved from proof of work to proof of stake. And so in summation, I wanted to kind of mention that the this kind of this and next week will kind of wrap up the introduction to the larger concepts of these, and then we'll start moving into more specifics on consensus mechanisms and what how to set up a wallet and these kind of things in future lessons. But to close it out, I just wanted to mention that next week there will be an assessment. So it'll be drawn from the lectures and the readings. It's meant to let you reflect your knowledge. So I'm not trying to trick you or anything. That's not my style. So I wouldn't be stressing about it. As long as you've done the readings and watched the lectures and attended them, you'll be fine. Also note from this week, the discussion post, the reading on bread pudding, I put it in as optional. It's extremely technical, so only if you're excited about that kind of thing should you read it. Don't feel like you have to. I don't understand half the stuff that's in there. I just wanted to include it as an example because it's a somewhat cited example that's been used to show this in computer science. Okay, cool. So enjoy the lesson for this week. The discussion post is open. If you haven't finished the discussion from last week, please do. I'll check them tomorrow. And yeah, have a good week. Cheers.